All right, let's talk about Resideo Technologies because their latest earnings report is a real head-scratcher. On paper, it looked like a massive victory for the company, but the stock market's reaction? Whoa, it was an absolute bloodbath. Okay, check this out, because this is the whole puzzle right here. On one hand, the company posts a record earnings beat, plus 29%. That's huge. On the other hand, the stock immediately gets vaporized, dropping 23% in a single day. That's not just a bad day. That's investors hitting the panic button hard. So what in the world happened here? So here's how we're going to piece this together. First, we'll look at those contradictory numbers, the beat and the bloodbath. Then we'll dig into the company's guidance and the, well, let's call them excuses management gave. After that, we'll zoom out to see the long-term changes they're making, analyze the market's harsh judgment, and then we'll wrap up with our take on what comes next. All right, let's jump right into the raw numbers from the earnings report. This is where the confusion starts. So, this is where things get weird. Look at the adjusted EPS, the earnings per share. It came in at 89 cents. The experts were only expecting 69 cents. Resideo crushed it. But then you look at revenue, and it was a tiny mess, barely shy of what Wall Street wanted. Now, a huge earnings beat and a tiny revenue miss, you'd think that would be a great day for the stock, right? Well, not this time. The market absolutely freaked out. The stock was sitting pretty at over $41 before the announcement. The next day, it completely fell off a cliff, closing at just over $31. That wiped out nearly a quarter of the company's value, literally overnight. And we know people were serious about selling. Look at the volume. Almost 7 million shares changed hands. That is 3 to 4 times a normal day's trading for this stock. This wasn't just a few nervous investors. No. This was the big money, the institutions, sprinting for the exits. And that gets to the real heart of it. See, the stock market doesn't just look in the rearview mirror. It's always trying to look around the corner. And what management said about the next quarter, that's what sent everybody running for the hills. So yeah, this is the million-dollar question, isn't it? If the last 3 months were so great, why did Wall Street suddenly decide the future looks so bleak? The answer, in just 2 words, is forward guidance. And there it is, the smoking gun. Management came out and cut their forecast for the entire year. They lowered their earnings per share target by about 7%. In the investing world, a company cutting its guidance this late in the year is a massive red flag. It kills all predictability. So what was their reasoning? They basically pointed to 2 things. First, an external problem. The market for residential heating and air conditioning is pretty weak right now. And second, an internal problem. They're having a chaotic time implementing a new software system. So you've got an issue they can't control and an issue they should be able to control. For investors, that combination is a total nightmare. Now, management's big defense on the earnings call was to say these problems were transitory. They kept repeating it. Don't worry, folks, this is just a temporary blip. It'll all be fine in a couple of quarters. But as that stock chart just showed us, the market simply was not buying it. Okay, so that's the short-term mess. But if you zoom out, way out, past all this quarterly drama, there is a much bigger and frankly more interesting story playing out. And this is the story that the optimists, the bulls, are betting on. The big idea here is that management is deliberately taking some hits right now to set the company up for a much better future. They're cleaning house, and that's always a messy job. And you want to see messy? Take a look at this. A negative cash flow from operations of more than $1.5 billion? That looks awful, right? But it's all because they wrote one single gigantic check to their old parent company, Honeywell, to get out of a nasty long-term legal agreement. But here's the payoff for all that pain. By writing that one check, they've potentially wiped out up to $140 million in payments every single year for the next 2 decades. It's a classic case of ripping the Band-Aid off. Hurts like crazy for a moment, but it de-risks the company for the long haul. And this isn't just some random move. It's part of a bigger 3-step plan. Step 1. Finish integrating their recent acquisition, Snap One, and get $75 million in savings. Step 2, we just talked about it. Get rid of that Honeywell headache. And step 3, the grand finale. Spin off their ADI distribution business to unlock its true value for shareholders. So you have this really compelling long-term story on one side. But on the other side, you have what happened after earnings. And the market's verdict was, in a word, savage. At the end of the day, investors just couldn't see the forest for the trees. The long-term plan sounded nice, but the guidance cut sounded scary right now. So they punished the stock. They basically said this company is worth a whole lot less to us today than it was yesterday. And just to put that punishment into context, this wasn't the whole market tanking. The S&P 500 was actually having a pretty good month, up almost 4%. Meanwhile, Resideo was in a free fall. This tells you the problem was all about Resideo. But here's the fascinating twist. While the market was hitting the sell button, the professional Wall Street analysts who cover this company for a living, they kept the faith. Morgan Stanley and Oppenheimer actually raised their price targets after the bad news, saying they were still bullish. They were clearly focused on that long-term reshaping story. So that leaves us with the big question. Who should you believe? The panicking market or the calm, cool, and collected analysts? How do you balance this huge long-term potential against some very real, very scary short-term risks? Well, for our part, we're landing right in the middle of the road. We're rating the stock a market perform. It's not a buy, it's not a sell, it's a classic wait and see. And here's why. That long-term strategy, it's smart. We love it. But the problems they're having right now are just too significant to ignore. Before we can get excited about this stock, we need to see proof that the HVAC market is getting better and that they've actually fixed their internal software problems. Until then, this stock is probably just going to be stuck treading water. So is there a way to play this? Well, here's one plausible idea. You could consider selling something called a cash-secured put with a price below that $29 low. Because everybody's scared, volatility is high, which means you get paid a nice premium just for making the offer. Then one of two things happens. The stock stays up and you just keep that cash. Or it drops and you're forced to buy the shares, but at a price that's even better than where everyone else panicked. It's a way to get paid to wait for a more attractive entry point. As always, please remember, this is not financial advice. You've got to do your own research. Thanks for tuning in.